Assalamualaikum. My name is Nur Atikah binti Azlan and I will present about question 1A. Calculate the earning per share for each alternative. Alternative 1 is all equity and the debt is equal to 0, equity equal to 350 million and the total value is equal to B plus S and the value is 0 plus 350 million equal to 350 million and the share price is RM 2 ringgit 50 cents. And the current shares is RM 250 million divided by RM 2 ringgit 50 cents and the answer is 100 million shares. For the new shares is RM 100 million divided by 2 ringgit 50 cents and the answer is 40 million shares. Next, for shares outstanding, 100 million shares plus 40 million shares, the answer is 140 million shares. And for earning before interest tax, RM 200 million. For earning per share, EPS, RM 200 million divided by 140 million shares. And the answer is RM 1 ringgit 43 cent per share. For alternative 2, 50% debt and 50% equity. The debt equal to RM 50 million and equity is RM 300 million. The total value equal to B plus S and the value is RM 50 million plus 300 million equal to RM 350 million and the share price is RM 2 ringgit 50 cents. And for the shares outstanding is RM 300 million divided by 2 ringgit 50 cents and the answer is 120 million shares. The earning before interest tax equal to RM 200 million and for the interest 10% RM 50 million times 10% equal to RM 5 million. The earning per share RM 200 million minus RM 5 million divided by 120 million shares and the answer is RM 1 ringgit 63 per share. For alternative 3, all debt, the debt equal to RM 100 million and equity is RM 250 million and the total value is equal to B plus S, which is RM 100 million plus RM 250 million equal to RM 350 million and the share price is RM 2 ringgit 50 cents. For the shares outstanding, RM 250 million divided by RM 2 ringgit 50 cents equal to 100 million shares. For earning before interest tax equal to RM 200 million and the interest is 10% equal to RM 100 million times 10% and the answer is RM 10 million. For earning per share EPS, RM 200 million minus interest 10 million divided by 100 million shares and the answer is RM 1 ringgit 90 cents per share. For question 1B, determine the distributions of income between debt holder, shareholder and the government for each alternative. So since there is no tax applied, we assume that TC equal to 0. So for the working one, formula is earning before interest tax times 1 minus tax, which is RM 200 million times 1 minus 0. The answer is RM 200 million. For working 2, the formula is earning before interest tax times 1 minus tax plus tax times with the percent interest times debt. So the answer is RM 200 million times 1 minus 0 plus 0 times 0.1 times RM 50 million and the answer is RM 200 million. For working 3, RM 200 million times 1 minus 0 plus 0 times 0.10 times 100 million and the answer is RM 200 million. So here is the table for each alternative, and since there is no tax, the cash flow is only to shareholders and bondholders. So for alternative 1, the earning before interest tax is 200 and there is no interest. So the earning after interest is 200 million and there is no tax. So the earning after tax is RM 200 million. And the cash flow to the shareholders and bondholders, as we see in the previous slide, working 1, the total is 200 million. So for alternative 2, the earning before interest tax is equal to 200 million and there is interest 10% of 5 million. So 200 minus 5 million, we got earning after interest 195 million, and there is no tax. So the answer for earning after tax is RM 195 million. So the cash flow equal to 200 according to the working tool in the previous slide. So for alternative 3, the earning before interest tax is equal to 200 million, and there is interest of 10 million, and the answer for earning after interest is 190 million, and there is no tax, and the answer for earning after tax is RM 190 million. So the cash flow to the shareholders and bondholders, as in the previous slide, the working tree is 200 million.
Assalamualaikum. My name is Nur Atikah binti HANAPI. So today, I would like to explain about the solution from case 1, question C. The question: in view of benefit and expense of debt funding, the corporation agreed to issue an additional debt of RM 60 million, resulting a debt-to-equity ratio of 1.5, primarily for the purpose of increasing its capital requirement. By applying Modigliani-Miller proposition, calculate value and the overall cost of capital of trademark auto syndrome Berhad. First, we have to calculate for value of firm. Before we find the value of firm, there is a step that we need to take. The first step is we need to find the shareholder equity by using debt to equity ratio formula. The shareholder equity will be amounted to RM 40 million ringgit after 60 million ringgit is being divided with 1.5 as the debt to equity ratio. After that, we need to find the value of firm by using the formula value equal by using the formula V equal to B plus S. The value of B is 60 million. Meanwhile, the value of share is 40 million plus 250 million, which is equal to 290 million. Thus, the value of firm will be equal to RM 350 million. Now, the calculation of the overall cost of capital. In calculating the overall cost of capital, there is also a few steps that need to be taken. First of all, we need to calculate for the value of RO. The formula for to calculate RO, we use the formula VL equal to VU equal to EBIT equal to divided by RO. Thus, the value of RO will be amounted to 57.14% after 200 million ringgit is being divided with 350 million ringgit. Next is we need to calculate for the RS. RS is the return of share by using the formula RO plus B over S times RO minus RS. The value after calculating using the formula we will get the percentage amounted to 66.89%. After we have achieved the value of RO and RS, we will obtain the overall cost of capital by using the formula RWACC equal to B over B plus S times RB plus S over B plus S times RS. Thus, the percentage that we derive from the formula is amounted to 57.14%.
Hi madam, I am Idlyn Nazurah binti Rahman, and the next question is case 1D. Explain why debt levels vary across sector and within industries. Our answer to this question is Every sector and industry have different debt level according to their nature of business. It can and does differ even between companies in the same industry. A company's demand for debt and its capital requirement is different from the others. Certain sectors like aviation and construction would have higher debt to finance its asset. For example, airline companies have to spend more to buy its own aircraft, to pay for its flight maintenance, hiring qualified pilots, and other expenses. Capital-intensive industries require significant financial resources to run its business, thereby making their debt-to-equity ratio is higher than those companies in logistics sector involved in supplying of goods, which is lower in debt. Let's move to the case number 2.
In the case 2, Randy Property Berhad is planning to invest a new project. In this question, there is an information about geared and ungeared company. In the question, it's also mentioned about all profit after tax are paid out as dividend. So, the profit after tax will be treated as D1, which is next year dividend. It also stated that there is no dividend growth. It means that the growth rate is 0.
Hi and Assalamualaikum. My name is Nur Atikah binti Zulkifli. I will present on the case 2, A, 1 Roman and 2 Roman. First, to find the cost of equity, which is KE for geared company. The formula to find a KE is next year dividend divide with the current market value and plus with the growth rate. So, we plug in into the formula the next year dividend, which is 510,000, divide by PO, which is 3,900,000, plus with the growth rate, which is 0, since there is no dividend growth as mentioned in the question. So, the KE we will get 13.08%. Second Roman is to find the beta value of geared using the asset beta formula. So there is 2 steps to find the beta value of geared. Step 1, we need to find the beta asset, which is ungeared. This step we will refer to the ungeared company amount. So the proxy equity beta is 1.0. The value of equity of ungeared is RM6,600,000. The value of debt of ungeared is RM0. So to get the beta asset, we need to use this formula, which is beta equity times with the value of equity divide by the value of equity plus with the value of debt times with 1 minus tax rate. So when we will plug into the formula the amount, the beta asset we will get 1.0. Step 2, we need to adjust the beta asset that we have calculated in the step 1 to get the new beta equity, which is re-geared. For this step, we will refer to the geared company data. For proxy equity beta is 1.0. This amount we have calculated in the step 1. For value of equity of geared is RM3,900,000. The value of debt of geared is RM4,180,000. So the formula to find the beta of equity is beta asset times with the value of equity plus with the value of debt times the value of debt needs to be times with 1 minus the tax rate and needs to divide by the value of equity. So when we plug in the amount into the formula, the beta of equity we will get 1.8. So after we have done the step 1 and step 2, we get the beta of ungeared company 1.0. This amount which we have calculated in the step 1. For beta of geared company which we have calculated in the step 2, we got 1.8. The beta is to measure the systematic risk. As we can see, the beta of geared company is higher than the beta of ungeared company. So, we can conclude that the geared company is more riskier than the ungeared company.
B. Explain the leverage effect and the implications to companies if earnings are insufficient to cover interest obligations. The answer is the leverage will increase as companies prefer to issue debt if internal funds are insufficient because the cost of issuing debt is lower than the cost of issuing share. This will lead and cause both high gearing problems and financial distress as the company fails to pay its obligation by its due date. If the gearing increases, the debt and risk will increase too because there are possibilities companies have lesser assets and high bankruptcy risk. Gearing will also introduce additional risk for equity shareholders. This is because they can get hurt if the company experiences high gearing problem, as companies will prioritizing to pay their debt first. If the company have debt and the equity holder can get nothing in return if the earnings are insufficient or cannot cover the debt.
Now, I would like to explain about the solution of case 2, question C. The question requires us to explain about the relationship between financial distress and capital structure. After that, propose the consideration that to be addressed by using debt financing. Financial distress is a situation where the promise made to creditor of company is broken or breached, which lead to bankruptcy if the solution is not taken into control. Financial distress situation involve costs such as direct costs, indirect costs, and agency costs, which lead to bankruptcy and change the capital structure and value of the firm. The capital structure will become small in value of bond, meanwhile the value of share will be increased. The proposition that can be addressed by using debt financing is consolidation of debt. Consolidation of debt is the consideration that company obtain loan from one lender for entire debt. Through this, negotiation can be reduced. At the same time, bondholders are able to purchase stock. Besides, protective covenant. This is the method which helps stockholder to get low interest rate of bond after agreements made with bondholder. It can be classified into two types, which is positive covenant and negative covenant.